you've got to let many of the largest institutions off the hook a little bit too, because I mean, the fact is, once you get up into the multi tens of billions or multi hundreds of billions of
Yeah.
dollars, then you just don't have, you've got too much capital to be able to deploy to the vast majority of diversifiers. You're kind of stuck
Yeah.
with betas to equities and duration and their derivatives, right?
Yep.
Like credit, for
Definitely.
example.
Definitely.
So what's always confused me though is how the small plans and the small institutions who actually have the flexibility to pursue more of an absolute return policy and are not so large that they'll consume all of the available bandwidth in some of these true diversifiers still fail to take advantage of this type of mandate flexibility, right? Why do you think that is? Do you think they just, they're sort of sucked into the gravity of trying to emulate their larger peers?
Well, I wouldn't say it's on the larger side, you have these staffs that are very sophisticated, right? So they can go into these most sophisticated types of strategies and eat up all the capacity. And at the same time, they command kind of better terms and fees. Where when you're the small fish in the pond and you're going in there and you can write an X dollar amount of check as opposed to, whatever, 10X, it's tough for you to get that kind of, I would just call it pure alpha off the bat by having a lower fee load. So then they're starting from a position automatically on the front end that, whatever that might be, 50 to 100 basis points. They need to make that up by finding managers that are also put up, good alpha and that don't want to grow to the moon. But what happens, the good managers, they see capital comes in, and then larger checks come in, and the fees go down. And the only way for those investors to get lower fees is to write those bigger checks. And so those smaller investors, can't necessarily do that, at least on the front end. Now, are there opportunities that are out there, arbitrage opportunities and different strategies where, it's worth the higher fees? I think so. At the same time, when you're dealing with small managers that have limited capacity, you need to find lots of those small managers that have limited capacity. And if you're managing some sort of larger pool of institutional capital, then pretty soon you have a lot of capital that needs to be put to work again, right? So you kind of you can consolidate a bunch of smaller plans, but then it becomes a larger pool of capital. And then, before you know it, you can't capitalize on those smaller types of niche opportunities. However, you can still now drive down fees for funds that started off with great alpha opportunities. And over time, as they grow, that alpha tends to get degraded. Mm-hmm. And then you kind of need to move on to the next thing or further diversify. But how much can you diversify until you just end up looking like the index, or you really don't really have enough active risk?
Well, that's it. I mean, that's the issue with these very large pension funds. You just described the evolution of what ends up happening is, billions and billions of dollars in money that needs to get deployed ends up having very little alpha or very little of that absolute bucket, and they have to just go to plain betas, right? Private credit, private equity, even on the idea of risk parity, right? That you have some equities, you have some fixed income, and you have some inflation assets. Those inflation assets become much more complicated to use commodities because of the CFTC limits that you have on assets. So you end up tilting towards TIPS, which is a way of protecting against a type of inflation, but not all types of inflation, right? So you, as you get bigger, you're just limited to betas, and you're even limited to being able to implement a robust risk parity portfolio that'll get you there. But I mean that's closer, right? And so it doesn't matter that you have purchasing power. It doesn't matter that you can get lower fees. You're just not going to get that big slice of 33% risk mitigation strategies. There is a sweet spot there of managers that have enough purchasing power. They can negotiate fees and have those big slices of alternative sleeves of the RMI and so on. And yet we're not seeing that sweet spot in AUM take advantage of those sleeves, right? So I mean, this is I guess as you consult with people, you're trying to push this agenda. I imagine trying to get them to open their eyes to this, right?
Well, yeah, and also think about these smaller institutions, right? The alpha opportunities might be more abundant for them, but they're smaller and they don't have large staffs that can really uncover all these opportunities.
It's a search problem for them.
Yeah. So hence they might hire an OCIO or some sort of consultant to do that. But then that also depends on how big that consultant ends up getting, and then what the uptake is of all those underlying strategies that consultant or OCIO might cover. Where if you're operating in a discretionary manner, you can act on these things relatively quickly. But if you're acting on a non-discretionary manner, it takes a bit longer to kind of implement a whole total portfolio strategy, because some of these institutions are set up where they meet quarterly, and they need to approve every single investment that goes into the book, right? And it's very tough to get 10 line items all approved at once. That would probably take for some setups a year or more than a year. Whereas if that was shifted more to a discretionary type of implementation, that could maybe be implemented right away. But then again, you're paying higher fees for that type of implementation. So the end investor needs to weigh, hey, am I getting the execution and a portfolio that's up and running much quicker, that's going to put me in a better position where I can outsource that decision-making process and all like the legal process, the operations, the investment due diligence, and I get good bang for my buck? Or am I better off sort of maintaining this strategic asset allocation and moving things on the fringe every now and then, hiring this manager, hiring that manager? I mean, only those institutions can decide. Of course, we would have our own biases because this is what we do, and there's some areas where that might be more appropriate than others. Maybe on long only equities, long only fixed income, it doesn't really make sense to outsource that to some sort of discretionary manager. But perhaps on the hedge fund side, risk mitigating strategies, private investments, perhaps that makes more sense because the complexity there is so much higher. All the operational things you need to do there, all the legal things you need to do there, perhaps that's worth it. And then some people might think, none of it is worth it. Others might think everything is worth it.
It's a real catch-22. I hear what you're saying totally, right? You've got a small institution that has the mandate flexibility and portfolio agility to be able to pursue a wide variety of different options, but they don't have the same level of resources or in-house technical expertise to be able to vet all of the different opportunity set, right? So then what do? Well, you pursue economies of scale, you consolidate up to a OCIO or a consultant, but then now you're choosing from a limited list of funds that have been already vetted by the consultant and are also getting allocations from all of the other different clients that have similar objectives and are pursuing similar types of strategies. And so you quickly run up against the capacity constraints, right? And then you've got these ultra large institutions, which it seems like it's just absurd if you've got 50, 60 or $100 billion for you to allocate, a couple $1 billion to diversifiers. These are like almost glamour allocations, right? You're sort of justifying an alts team without actually making any difference to the risk budget or risk profile of the overall plan or institution. So it's a real quagmire. I absolutely see the problem. It does seem like there's an opportunity in the small to medium sized plan space to pursue very different objectives in sort of a non-scaled OCIO context that allows them to pursue these types of opportunities without consuming all the bandwidth and sort of pricing themselves out of the market that's going to be most accretive. So it's very interesting.